Okay, welcome everyone to today's webinar. The Savvy Women Investors are planning for their futures. Thank you all for joining today. First, I'd like to start off by thanking the McGill Women's Alumni Association for inviting me to speak with you all today. I am so excited to be here and to be able to share the knowledge that I've gained over the years and hopefully help you all take control of your financial goals. So my name is Keely Simpson. I'm an associate portfolio manager and wealth advisor with BMO Nesbitt Burns. I last week actually celebrated my 14-year anniversary, so time flies. I don't know how that even happened. I work on a team. I have a business partner. His name is Lee Rohrbeck, and we're a team of 4. We are based in Toronto, Ontario, where we have actually been locked down since November. We have been working together for a number of years now. One of my biggest passions as a portfolio manager is empowering women to learn more about how to take control of their finances. As we go through this presentation today, and I'm going to show you the agenda in just a moment, you're going to see that that there are quite a few differences between men and women, and that's why we're doing this presentation today just for women. And the other thing I'd like to mention is that I am a mom of 3 and of 3 little children, 3 and under. So it is a very busy household, and I also have 2 dogs, and I am doing this from my home office. So if there's any background noise that ends up happening, I do apologize, but we're just, trying to make it work. We're not actually allowed to go into the office right now because of the stay-at-home order in Toronto, so just doing the best that we can. I'm also going to be taking some questions as we go along. So if you do have any questions that you'd like to submit, I will pause halfway through, go through some of the questions we've gotten, and then keep rolling from there. So I'm going to go ahead and start sharing my screen now, and that way we can start looking at the presentation together. So it should be coming up now. And okay, we are live. So I'd like to start off with a quote. So money is genderless, but investing for women is different. So what I mean by that is, just generally speaking, women tend to be less confident in their knowledge about finances than men. And this is just because, generally speaking, men have usually been the ones to take care of the household finances. So we know that knowledge leads to hands-on involvement, and those who consider themselves knowledgeable obviously will take more control of their financial goals. So that's one of the quotes I wanted to start with. And then the next one comes to that planning piece. So planning is bringing the future into the present so that you can do something about it now. So really, when it comes to planning for your future, whether that's a retirement plan or planning for a major purchase, whatever goal it is that you're trying to plan for right now, basically making sure that you're taking the steps to get there is really important. So it does require some action on your part to make sure that you're taking control of your financial goals. So the agenda for today, I'm going to start off with a little quiz. So if you have a pen and paper ready, or you can just take a note in your phone, just to help answer some of these questions that I'm going to ask you, just to get us thinking a little bit about where we're at with our finances. That would be great. So then we're going to go into investing for women and why that's different, some of the unique challenges that women face planning for retirement. Then we're going to go through the basic steps to building your net worth. And then we're going to talk a little bit about selecting an advisor. I know that there's some questions around that, so I thought that we could delve into that a little bit. So the quiz is really, what are your goals and what are you doing right now to reach them? So to maintain your current lifestyle after retirement, how much capital do you think you'll need to have saved? What are all of those sources of retirement income when you do eventually get to that place where you're retired. And I know today's audience is 35 and under generally, so that may not be as relevant to you because that could be, you know, 30 or 40 years from now. But it is important to think a little bit about that because eventually you'll want to have enough saved that you can, you know, enjoy life on a beach, quote unquote. So how much income will each source of retirement income provide you? What percentage of your gross income are you currently saving? And what percentage of that is your net income? And what was the return on your investments and savings last year? Obviously, last year is a bit of an anomaly because we went through a big market crash at the start of the pandemic. So maybe last year is not the best sort of reference point, but over the past couple of years, how have your investments done, right? So the next slide I'd like to go through is women learn before they invest. This is really important because women love to just learn, get as much knowledge as possible before actually investing. And one of the challenges that we see in financial services today is it's just all prepackaged for people, and there's not a lot of explanation going on behind the scene to make sure that everyone is comfortable with what they are doing, right? So there needs to be some patience and a different approach when it comes to teaching us all about the different options that are out there. As women, we communicate differently, so we may not respond just generally the same as a man would, and that's just on the statistics on average. And then also on average, because we have different life experiences and we tend to be more risk averse, we tend to look to invest in more conservative investments. We don't like to take bigger risks, quote unquote, when it comes to our portfolio, our hard-earned money. And women also tend to have some different fears than men do. Like there's this saying, you know, being the bag lady, right? So there is a little bit of difference when it comes to women versus men when it comes off that way. So I'm going to go to the next slide. So the other challenge is that, you know, it's typically, when it comes to retirement, it is typically presented as a couple's experience, right? So the reality, especially for women, is that it is often statistically lived alone. Oopsies. Oops. We're just going to exit that. Sorry about that. So typically presented as a couple experience. The reality, especially for women, is that it's very often lived alone. Women tend to have worked decreased hours if you've taken a leave of absence to have children. So you're not putting in as much into the CPP, the Canada Pension Plan, or the Quebec Pension Plan. And the old age security. So EI, all of that, there's a bit of a gap when it comes to men and women if you are taking like a one-year maternity leave, for example. Women are living longer than men statistically, so needing to have that smaller quote unquote nest egg last longer, right? There's that confidence piece in investing, so gaining that knowledge, right? Making sure that you feel knowledgeable enough to feel confident in the investment decisions that you're making. Also, interestingly enough, the non-financial aspects of retirement, women do come out ahead. So that's nice to hear. So what I mean by that is men who often tie their sense of purpose and identity to their work can find it challenging to replace that in retirement. Whereas women's identities tend to come from nurturing relationships, from nurturing family. You know, we're more involved when it comes to that with our relationships. So it gives us a bit more purpose for many years to come after we've, you know, we've hung up our coats and we're ready to enjoy, you know, life on the beach, quote unquote. So it would be wise for men to consider, you know, how they intend to fill their days in their retirement when it comes to their planning for retirement. Interestingly enough, I have a lot of women clients and a lot of male clients, and a lot of the clients who have recently retired, especially actually through this pandemic, who are men, have had a challenging time because they didn't really know what that was going to look like for them. Whereas women, because we have those relationships that we've nurtured, they tend to come out ahead. So it is just a surprising thing to see as it unfolds. Obviously, this past year and a bit has been very different, extremely difficult for so many people. So it's not really a great comparison, but it is just something to think about. So I do have a retirement expense worksheet that can actually be used as a budgeting tool. So if you would like to receive that, just let us know. There's going to be a survey at the end of the webinar today that you're going to receive in your email. So if you would like to receive this expense worksheet, just let us know and we'll get that off to you. It does allow you to put in what your current expenses are with, your mortgage or your rent, condo fees, property taxes, groceries, and then you can actually use it to try and figure out what that future expense is going to look like. Obviously, if it's 30 years from now, that number is going to be like quite inflated based on inflation right now. But I mean, it's just to give you an idea of what that looks like. So the next slide is we're going to look a little bit at, what does retirement look like to you, right? Obviously, this is a really long time from now, but because women are living longer, and if women are already living longer, then we're going to be living even longer by the time we get there, and it's no longer a set point in time. There is that sandwich generation where women now are facing pressures to take care of their parents at the same time as their kids. We have that declining pension aspect. So now companies aren't providing what's called a defined benefit plan as often as they used to. The responsibility is on you to be saving for your retirement. And a lot of people are retiring with debt right now. So it's just something to consider when you do look to plan for your future retirement. And then a couple of traditional rules of thumb or retirement myths. So I am fine. I have a company pension plan. Again, that's not so relevant for today because a lot of companies are not providing that private pension plan anymore. I need 70 to 80% of my pre-retirement income. I like that. That's a good one. I've heard I need to save $1 million. Well, it really depends. You probably need to save more than that now if you'd be retiring in 30 or 40 years from now. And I will be fine if I only withdraw 4 or 5% a year from my savings to retire. This is actually another really good one. It's a good rule of thumb I use for my clients, that 4 or 5% rule. As long as your return on your investments are higher than inflation, that 4 or 5% rule works really, really well. So if there's anything you can take away from today's presentation is figuring out what you need to draw. If you had $1 million and it was $50,000 a year that you were going to be taking from your portfolio, would that be enough for you? And how do you get to that $1 million, right? Saving, which we're going to talk about today. So there is no one size fits all solution. So another thing to consider, which I've already mentioned, is that women are now taking care of their parents. We leave the workforce for longer periods of time if we actually need to take care of our parents or take care of our kids, adult children returning home, caring for grandchildren so that their parents can work, outliving your spouse, divorce, and then working longer, how much and in what capacity is another area that we see a lot. So I'll take a pause here for some questions. If anybody has some questions, let me know. There were some other questions that we had before, so I'll just go through some of those. So one of the questions that we received ahead of today's webinar was, do you have any tips to invest in responsible, sustainable, and ethical companies? So there is actually the MSCI Sustainable Index that you can Google, and you can see how companies rank when it comes to their ESG score. So that is one area. And then there's a lot of mutual funds and ETFs, so exchange traded funds, that offer sustainable products, so that you don't have to worry about doing your own research when it comes to this. It's something that you can just have sort of ready-made for yourself. What do I think of cryptocurrency? So, and is that something that you should be investing for yourself? There is still a lot of misinformation out there, and a lot of information that's still missing when it comes to that cryptocurrency piece. If that is something that you're interested in, I would look more to an exchange traded fund that offers the cryptocurrency exposure, as opposed to going and buying that, Bitcoin, for example, just so that you can have it at more liquid. That's the part that is concerning. Obviously, if it's illiquid, then you're not able to gain access to your capital whenever you need it. That would be that could sort of be challenging if you got into a situation where you needed access to that money, right? Can I talk a little bit about how to plan investments and taxes when one has a multi-jurisdictional and international career? So when it comes to Canada, we're going to talk a little bit about our plan in a few minutes here. So hopefully maybe I can answer that while we go through the savings piece. So we'll try and answer that as we go through that. And then, what is the best tool or resource for a beginner in investing? So Investopedia, which is a website that you can use to learn about the different language that people use when it comes to investment products, I think would be a good one. And then, there's also some online platforms that target beginners for investing. Sorry. So BMO, Bank of Montreal, has one. It's called Smartfolio. Wealthsimple is another one that is really well known in the world right now, and they just had a big investment from another company. So I mean, I think those platforms where they're targeted for you to be able to learn while you're building your portfolio, I think that those are really great options that are available to you. And then Investopedia is another place where you can learn about the different plans, the different products that are out there, and what those entail. So I'll just see if there is any other questions before we keep going. Okay, so the budgeting template looks great. Are there any budgeting tools that link to online platforms such as Mint so that expenses are automatically matched up against budget? Yes, you can use Mint, and you can get that connected to your online banking depending on which online banking platform you use. I would invest in that. I'm not sure if that's still a free option or not. And you can also, when you're doing your online banking, you can also categorize your different expenses that are coming out so that it can just be done automatically for you. But that's more of a, what am I spending my money on versus, budgeting to make sure that you're keeping track of the different expenses that you have versus what you're actually saving versus overspending on. And then what kind of debt are people retiring with, and what is a bad thing or to be expected? So a lot of people right now are retiring with mortgage debt. The housing market in Canada has grown exponentially, especially in Ontario and in BC and Vancouver. So I think mortgage debt is something to be sort of expected. And if you can try and minimize that as much as possible before retiring, or have enough cash flow coming in to cover that mortgage expense and taxes, that would be great. A lot of people are also retiring with what's called the homeowner line of credit debt. That's not a bad thing, because when you go to sell your principal residence, if you're going to downsize, you can pay that off. The interest rates have been really low. They've been really reasonable, obviously, because interest rates right now are at all-time lows. So when you go to sell your house or your property and you have that line of credit against the property, it will just go to pay it off and then you can downsize if that's something that you're interested in. Or a lot of people are renting and then just using the money that they've made in the real estate market to essentially pay their rent by investing in a financial portfolio. Can there be more technical trading trainings, e.g. using Wealthsimple Trade? I think that would be more of a Wealthsimple platform directed question, which I can try and answer offline and see if that would be something we can go through. And then in terms of what my thoughts are on real estate investments in terms of retirement income, single family rental properties. So I think if you can get into the real estate market, I think it's a great place to build up your wealth. As we've seen with the housing market in Toronto, in Vancouver, and even in Montreal, the market has grown substantially. So I think also the other piece that's going to happen as we see interest rates going up from this, eventually when things do get back to normal, quote unquote, interest rates are going to be going back up again. So there may be a correction in the housing market. A lot of people are talking about that right now. Whether that's going to happen or not, I'm not sure. But essentially what you want is you maybe want to build up enough capital to get a down payment, right? And budget for an increase in mortgage rates. The stress tests that the banks are going to be putting on to borrowers are going to be changing as of June 1st. So I'm not sure if you've read that in the news or not yet, but as of June 1st, I believe they're going to be using an interest rate of 5.75%, which is 1% higher from what they're using right now, and that is to mitigate against any changes in the housing market. I think long-term real estate makes a lot of sense. The only challenges with real estate versus building up a financial portfolio is that with your financial portfolio, at least your dividends can pay you a sustainable income into your bank account. Whereas with real estate, if it's your own property, that's not happening. But with a rental property, obviously that makes a difference, right? So as long as you can have good tenants that are going to be in there, that are going to be paying their rent, that can cover your mortgage and your expenses, I think it's a great way to build up that wealth. And I really think that there's going to be an opportunity coming in the next year or so, maybe it's in 2 years from now. I'm not sure when that opportunity is going to happen, but there is a lot of talk about a correction in the housing market and how the housing market has gone, so high so quickly with interest rates being so low. I think you're going to have an opportunity to get in there. I think there was another question. Yes, this is going to be recorded, so this is going to be available to you after. And then I think we're getting a lot of questions here. So I think what I'll do is I will keep going through the slide deck just to make sure that we can get through our planning piece. And then I will come back to these questions after. So the next part of our presentation is basic steps to building your net worth. So the first step is you want to have a plan, right? So you want to create a balance sheet. You want to know how much are you spending and how much is left over. In terms of the rule of thumb to know how much you should have left over, it really depends, right? Like if you're just starting off in your career, you may not be earning a high enough income to cover all of your expenses and then have enough to be saving, right? So I think you need to balance that a little bit. Create a statement of net worth. So you want to know what your assets are. So if you have any assets, those would be your financial assets that are in your bank account or in your investment accounts, and then minus your liabilities. So what do you owe, right? That could be your mortgage or homeowner line of credit. It could even be an investment loan. Those have become popular again now with interest rates being so low. That becomes your net worth. And it can help you determine your net number. So if you have a pen and a paper, you can actually do this right now. You can create a balance sheet, right? You can take it in your mind and say, okay, if I make $5,000 a month, or $10,000 a month, or $2,000 a month, right? And then how much are my expenses? If you can think about your rent or your mortgage, your taxes for your property if you own one, think a little bit about how much you're spending on groceries, on any personal care, any child care, if you have children, right? So think a little bit about how much do you have that then becomes left over? Do you have anything that's left over? Where can you where can you squeeze the numbers, quote unquote, to pay yourself first, right? How much can you save, and how much should you be saving to reach your goal? And that can be figured out. There's an online platform which I'll send it out to Kay after, that can help you basically plug and play your numbers, where you can figure out how much you should be saving to reach your goal. BMO has an online platform for that you can use yourself to try and figure out from a financial planning perspective where you're at today. So paying ourselves first, so going back to that budget, that expense worksheet, or using Mint to link with your online banking. You want to have an emergency fund. A healthy emergency fund would be, 4 months of savings. 4 months of savings means 4 months of whatever your net salary is would be a good number to have in your emergency fund. If you're in a job that is a niche market, you may want to have a bit more saved up, because it may take you longer to find another placement. If you're in a job that would be, it's easy to find another job, then maybe you only need 2 months or 1 month, right? So it really depends on that. But the emergency fund, the rule of thumb really is to have 4 months of net savings, or net income. You want to have, if you are earning T4 income, you want to have savings into a registered retirement savings plan. And you don't need to max that out every year. You just want to make sure that you're putting enough in so that you can get some tax savings. And we're going to go through that a little bit in a few minutes. You want to have a tax-free savings account. If you're 18 and you're, age of majority, you want to have a TFSA that you can invest in. And I'll talk about the difference between an RSP and a TFSA in a couple of slides as well. And you want to have a reinvestment program. And what I mean by that is, you don't want the money to just sit in that plan in cash and not doing anything for you. You want to make sure that that's working for you. So the next thing is, you want to set your objectives, right? So are you saving for a major purchase? Is it that real estate? Is real estate something that you want to get into? Do you want to buy a second property? Do you want to buy an income property, right? So you want to set your goal. Is retirement something that you want to be setting as your goal right now, depending on which stage of life you're in? Is children's education important to you? If you have children, do you want to start saving in what's called a registered education savings plan? Is estate planning important to you? Do you have proceeds from insurance, right? Gift planning. So actually right now with some clients, we're doing a lot of gift planning, legacy planning, which has been very interesting conversation with a lot of clients. So that's another area where we're seeing a big increase in interest. The next is, so we have a plan, we've set our objectives, and we want to develop a retirement plan. So there's 3 sources of retirement income. There's government plans. There are company pension plans. If you're working with a private company, then if you're lucky enough to have a defined benefit plan, then they're going to pay you a set income when you retire. If you're saving into a company pension plan where they're matching your contribution, then that's great too. And then you have your personal savings, right? You have your RSP and your tax-free savings account. So replacing today's income, I'm not going to spend a lot of time on here. We used a 5% inflation rate. Just to give you an idea that $60,000 today would be $98,000 10 years from now, $159,000 20 years from now, and obviously 40 years later would be $422,000. So it's just to give you an idea that obviously $60,000, an apple today is not an apple tomorrow, and your investments need to be keeping up pace with inflation so that you are constantly building up that net worth. So the advantages of a retirement savings plan are that you get tax deductible contributions and you get tax deferred compounding, right? So the investments inside of a registered plan are growing tax-free. So that means that the government is not taxing you on any income earned or dividends earned inside of that, or any capital gains, right? And you get those tax deductible contributions. So some of my rules to live by, so open a registered retirement savings plan and a tax-free savings account. Contribute your maximum if it makes sense from a T4 income perspective. So if you're in the highest tax bracket of earned income, you want to contribute that maximum so that you can get money back from the government that you've already paid in, and then you can use that savings to contribute again to your RSP. And then you want to try and see if you can save any money inside of a TFSA. The other benefit of an RSP is that if you are going to be buying a home for the first time, there is that first-time home buyers plan available to you. So, you know, you can put the money into the plan, and then you can withdraw some of it tax-free where you're paying it back over a set number of years, and then you can put a down payment on that property if you're a first-time home buyer. So if you're thinking to yourself, oh, gee, like, I'm not sure, should I put money into an RSP if I want to buy my first place? Well, there's that home buyers credit that you can access, right? The first-time home buyers. The other thing is that you can withdraw money from your RSP tax-free with the lifelong learning plan. So if you end up returning to school and you need to gain access to that money, you know, you can draw on it for education purposes as well. So you want to contribute early each year, and what I mean by that is, you know, January 1st comes around, you want to try and get it in there as quickly as possible, if it's possible, obviously not always possible, just so that you can get that benefit from growing your savings from an investment standpoint. The other thing that I recommend to clients a lot is to contribute monthly, so that you just have that monthly amount coming out of your bank account. You know it's going to be directed to your TFSA or to your RSP. And you just know that that's every single month, even if it's $25, right? Start small, $25 every month, you're putting it in just to get, you know, used to that. And then you want to invest wisely, right? The 2% difference. So what I mean by that is a 6% rate of return, year 5 is $29,877. And at 8%, that's $31,680, and at 10%, that's $33,575, right? So obviously, over a long period of time, those savings growing, compounded, especially tax-free, can really make a huge difference. And this is how a $5,000 annual RSP contribution grows, right? Through compounding at different rates. So the TFSA was introduced back in 2008 by the federal government. You're allowed to contribute a maximum of $6,000 per year. The government kept the limit the same for 2021. I get a lot of questions on the TFSA, so we're going to spend some time on this. Your investments grow tax-free, so interest, dividends, and gains, all tax-free. If you've never opened one, you can contribute $75,500 today if you turned 18 before 2009. Some of the rules to think about: do not over-contribute to the TFSA. They will charge a penalty. And do not contribute, withdraw, and contribute again in the same year. It's important because these are the rules that the Canadian Revenue Agency has set out, Canada Revenue Agency. And, you know, we don't want to get any penalties by accessing the account in the wrong way. So TFSA versus RSP. So scenario 1, you've got a marginal tax rate at 40% when contributed, 40% when withdrawn. Scenario 2, it's the same, 40% when contributed, 20% when withdrawn. And scenario 3 is 20% when contributed and 40% when withdrawn. So I can send this out if that's something that you're interested in. Just let us know. There's some pre-tax income in the first scenario for the TFSA. So your pre-tax income is $5,500 in both scenarios. Your income tax payable is $2,200. Your net contribution becomes $3,300. The value 20 years later at a 5% growth rate, right, is $8,756 versus that $14,593. But your income tax payable when you've drawn it out from the RSP becomes, you know, $5,837. So it's a net the same. right? So if you have a marginal tax rate of 40% when you're contributing and 40% when you're drawing it out, then TFSA versus RSP, becomes the same. It's the same. So these are some of the questions I get a lot. I think it's always important to have a balanced approach when it comes to, your planning. So if you can have your RSP and your TFSA working for you, I think that that's great, because I think if you have that balanced approach, I think you're gonna see that working for you. Obviously, if you have a 40% tax rate when you're contributing, you're getting a bigger tax refund from CRA. And then you have a 20% when it's withdrawn, then obviously your net withdrawal is going to be higher, right? Because your tax bracket was higher and then it's lower. And that's really the idea when it comes to planning for retirement. You want to see, where can you maximize your tax benefits that are available to you right now so that you're not paying as much tax down the road. So how long will $250,000 last me? I get this question a lot, so I just thought I would put it in here. So if you have a 6% rate of return per year and you retire now, your annual withdrawal of $18,000 a year is going to last you 18 years. But if you waited 2 years, so if you were able to work for 2 extra years, then your portfolio will last you an extra 5 years. And that's why I say it's important to plan ahead, because if 2 years of working, makes that portfolio of yours last 5 years, then maybe that's worth it to you. Maybe it's not, right? So that's why it's important to plan when it comes to planning for your retirement. So you want to create and manage an investment program. That's our next step here in our plan. So we've had a plan. We set our objectives, we've developed a retirement plan, and then we want to create and manage our investment program. So in terms of your needs and objectives, what is your current financial picture? What is your risk tolerance? And what I mean by risk tolerance is, if your portfolio were to go up by 10% and then down by 20%, in the same month, how would that make you feel? Can you handle that? And if not, that's okay. Not everyone can. So that really is important to think about when it comes to your investment management program, is your risk tolerance, your time horizon. So how long do you have until you retire, or until that goal of a major purchase? So is it 10 years? Is it 5 years? That will determine what you should be investing in. Your knowledge. So how comfortable are you with investing? How much knowledge have you gained? Your time commitment. So how much time can you allocate to investing? And your goals. So I'll just go through this investment menu a little faster than I would, just because I want to get to those other questions. So you've got short-term, fixed income, and equity. So short-term is something that's coming to maturity within a year. You have fixed income, which is bonds and preferred shares, and then common equity, which is stocks, right? So GICs are guaranteed investment certificates, which are very low risk because they're 100% guaranteed. They pay you interest, but right now a 5-year GIC is paying less than 1%. So, I mean, you have to balance that. Your rate of return minus your inflation rate right now is your real rate of return. And then if you have a taxable account minus the taxes that you're paying on that, is your after-tax rate of return. So that's why you want to think about your investment options. So we've got government bonds and corporate bonds. We have preferred shares, which can provide you with regular dividend income. One note on preferred shares is that with interest rates, they can be very interest rate sensitive. So although historically prices on them have been less volatile, we have actually seen a lot more volatility in them in the past couple of years. So that's just something to be mindful of, and with bond prices as well, right? So when it comes to bonds, they are supposed to be that that conservative piece in your portfolio, but with interest rates being so low right now, and we know interest rates are going to go up, so that means bond prices are going to go down eventually. You want to be mindful of that. So you want to balance it out. Common stock is when you own shares in a company, and so you have ownership rights in that company. If a company is paying dividends, then you can expect that on a quarterly basis, or sometimes they pay monthly, and you have that capital appreciation potential, right? So you also have capital depreciation potential like we saw last March, and I'm going to show you guys a slide on that. Asset mix is a very key factor when it comes to building out your portfolio. You want to have a strategic blend of stock, bonds, and cash, right? So you don't want to have, I mean, you can have 100% equity, especially if you have a really long time horizon, but it comes back to that risk tolerance, right? How much risk can you handle? And why is it important, right? So you have a strong influence on that risk reward trade-off. And the most effective method of accommodating unique investment preferences is through that asset mix decision. This is a chart of the US and Canadian stock markets over the past 5 years. You can see that 2016, 2017, 18, 19, 20. So if you look at 2020, you'll see that there was a huge drop, right? The markets last year went down by 35% at the beginning of the pandemic. This was a very tough pill to swallow for a lot of people who were 100% invested in equities. But then you can see that if they didn't sell at the bottom, that their portfolio would have recovered, right? If they had just stayed the course. Obviously, very scary. Last year was very intense because there was not just that market crash. We've also been living through a health crisis for the past 14 months, which I don't need to talk with all of you today about. We all read the news, so that obviously was very concerning. So thankfully, the markets did recover, and now the markets are doing well, quote unquote, so that's good news. Diversification reduces risk. You don't want to have an abundance of different names in your portfolio because you're not going to get a higher reward off of that. But you want to have, 20 or 30 companies in your portfolio if you were building it out, and that way you can hopefully diversify enough, right, so that you can have a higher return and lower risk. So diversification by asset type. So we talked about asset type when it comes to common stocks, bonds, or preferred shares, or cash, by industry. So right now we've seen a huge divergence in the market in the past, I guess, 2 months now. Whereas what was working last year in the markets are not working this year. So last year, what was working in the markets was technology, healthcare, right? Consumer discretionary. Those were the sectors that were doing really, really well. This year, however, they're not performing as well. Now we're seeing a huge shift into cyclicals, right? So financials, we've seen a huge shift into materials. Like these are the sort of markets that are part of the market, that are supposed to benefit from the reopening that's happening in the United States. Obviously, we're not feeling that here in Canada. And by country. So you want to have diversity when it comes to the countries that you're investing in. So you want to have an allocation to the US, you want to have an allocation to Canada, and you want to have an international selection as well. So some of the current market conditions that we're seeing right now, obviously there's a lot of talk about that yield curve, the difference between long-term and short-term rates. I can send out some reports if someone's interested in reading more about it. Just let us know in that Survey Monkey that we're going to send out. And basically now what we're seeing, again, as I just talked about, was that divergence in the market where you're seeing cyclicals are doing a lot better than what was working last year. When is the right time to invest? So the risks of market timing, obviously last year, if you sold out of your portfolio when the market was down 35%, that's not great. So you want to stay invested for the long term. You want to buy value. You want to buy companies that are going to pay you while you wait. And what I mean by that is you want to have a dividend reinvestment plan. And if you do have, if you are buying stocks directly versus exchange traded funds or mutual funds, you want to make sure that you're on a dividend reinvestment plan to maximize your return, right? And you want to take a long-term perspective. So tax considerations, if you have a taxable account, so dividends versus interest, interest is taxed higher because you don't get that dividend tax credit, and you want to have that deferral of capital gains, right? So, so that's that. And then the final piece of our presentation before we go into these questions that are building up. I see a lot of questions here. So I will get to all of these in a few minutes. So I'll just finish off here with selecting an advisor. So in terms of the different advisors that are out there that are available to you, so if you have a Canadian bank account, so whether you're with BMO, TD, RBC, then you would have access to a financial planner in your bank branch. So you would set a meeting, obviously right now it's all virtual, and you would talk to that financial planner about what your options are and building out a financial plan so that you can make sure that you're on target. This is all free, offered by whatever bank you're with. So I would take advantage of that as your first step, right? From there, that financial planner can create that financial plan for you, make sure that you have a good investment program. With regards to your investment options with a bank financial advisor or bank financial planner, sorry, is you'd really only have mutual funds available to you through the bank. So whether it's TD mutual funds or BMO mutual funds, so those are the options that would be available to you. Then if you went to like a Wealthsimple, for example, you could build out your portfolio online and you can have access to what's called exchange traded funds, which I didn't talk too much about because I see lots of questions about those, and I'll delve more into that in a minute. And then once you're comfortable with that, once you're building out your portfolio, once you've built up you know, a bit of a nest egg, quote unquote, then maybe you want to look at working with a full service advisor. A full service advisor is someone who can buy you stocks, bonds, mutual funds, exchange traded funds. They can buy you a whole, you know, there's a whole realm of different investments available. And if you are going to go that route, if you've built up your nest egg to, you know, so that it makes sense from a fee perspective for you, then that's great. So the process is you want to have interviews with different people. You want to have, you want to ask maybe a family member or a friend for a recommendation on who they're dealing with. You want to talk about expectations with that person, and you want to talk about the costs, right? There's fees or commissions. The services that would be provided by a full service advisor are financial planning or wealth planning, setting goals and objectives, investment research and advice, asset management, progress reports, right? You got you getting your monthly statements, financial updates for you, and portfolio reviews, and service expectations, right? So how often should I be reviewing my portfolio or speaking to my advisor? Should it be 4 times a year? Should it be 6 times a year? Should it be twice or even just once a year? That depends on you. That depends on, you know, how much engagement do you want to have, right? If you're just starting out, I think you want to have more. More is better than less, and you want to work with someone who will be available to you to make sure that that they're teaching you and getting on point with your financial goals, right? So I think, okay, perfect. So now I'm going to go into these questions because we have 10 minutes left, and there's a lot of great questions. So let me see here. Okay, so thank you, everyone. I've put my contact information on the slide. If you would like to get in touch with me, please feel free to do so. The McGill Women's Alumni Association is going to send out a survey. In that survey, there's going to be a link to also a Survey Monkey. So if you wanted any of the research or the budgeting spreadsheet that I mentioned, please just put that in there and I will get that off to you. Okay, so going back to our questions. So these are very, very good questions. Okay. What percentage of my income should I be setting aside for savings, i.e. the 50-20-30 rule, 10%? So if you can manage to do 10%, I think that's great. I think that rule of thumb, 10% really is accurate. I think if it's available to you, that would be really, really great. I am torn on RSP. Some say that it is best to maximize them all the time. Others say it is best not to use them when you're beginning in your career, which is what I talked about before when it comes to the Tfsa versus Rsp. So when you're building up in your career, right, and you may have a lower income today than you will say in 5 years from now, I think it makes a lot of sense to save that RSP room that's available to you for higher earning years that are ahead of you, right? So you want to put in enough to your RSP that you'll get a tax savings for the taxes that you're paying, but you don't necessarily want to maximize it to a point where you're going to be putting in more than you should in terms of reaping the benefits from the tax refund. That's really the only reason why you want to use the RSP versus the tax-free savings account, for example. So really, I think there's a tool, there was an online tool that you could use where you could, it's an RSP maximizer tool, and I think that it's available through any tax preparation modules that are available online. So you can put in your income and you can optimize what your RSP contribution should be, and it will tell you if you put in $5,000, what your tax refund would be versus 10 versus 15, and you can see that you're going to hit a point where it doesn't make sense to put in that extra dollar and just save that room for higher earning years. So hopefully that answers that question. Okay, what kind of debt? We talked about that. Okay, looks like we've talked about these, which is great. Okay, here we go. Should you avoid investing in your tax-free savings account if you plan on moving abroad in the next year or so? My understanding is the account needs to be closed if you go to the UX, for example. Yes, you do need to close it. If you're moving, if you become a permanent resident of the country that you're moving to, it is available only to Canadian citizens, Canadian residents. So I would still use it as long as you're here, and then when you do actually move, plan to close it down. I think they actually give you some time before you actually have to shut it down. That way you're maximizing your returns, your tax-free returns. The government can't take that away from you. CRA isn't going to take that away from you. So I would definitely maximize the room that you have right now. If you can do it, maximize your savings plan. And then if you end up moving abroad and you actually do need to close it down, at least then your investments have grown tax-free while they could. All the financial help books I've read have info specific to the US. Do you know of any good beginner investing financial planning books that is Canada specific? Yes, there are some good books out there. I can send them out to Kay, to the McGill Women's Alumni Association. Maybe we can even post it on our social media channel, a couple of books that would be helpful. So we'll get those out to you. I'll write that down. And we've gotten that one. Okay. Okay, what do I think is a more savvy investment? Paying down the mortgage at an accelerated rate, or save on interest, or investing excess cash in a financial portfolio? So I think it makes more sense. Well, it really depends, but interest rates are very low right now. Obviously, they're going to be heading higher eventually. So I think it makes sense to have a balance between the two, and you can always use the excess cash that you've built up in your financial portfolio, your excess returns, for example, take the profits every year and move them into paying down your mortgage. One doesn't mean that you can't have access to the other. And what I mean by that is, let's say you had $5,000 of extra cash in 1 year, right? So you take that $5,000 and you invest it inside of your tax-free savings account. And let's say you've earned a return that was, I don't know, 6% or 7% or even 10%. So you take that $500 that you've earned in your profit for the year, and you can take that and move it into the mortgage, the excess mortgage payment that you want to make. I know I'm talking a little smaller numbers here, but it's just to give you a sense that it is possible to do that. The only challenge, of course, with using the tax-free savings account to do that is that you can't put money in, withdraw, and then contribute again in the same year. You can put money in 1 year, withdraw, and then contribute again the following year. So you can still do it. You just have to keep track of that. So I would just be careful on that piece. But I think it makes sense to have a balance between the two. Okay. Okay. What advice do I have for somebody who is looking to start investing by themselves, not with an advisor, either human or robot? Are there any strategies, tools, and or resources that you would recommend? So yes, I think, well, there's a lot of robo advisors out there right now, like Wealthsimple we've talked about, and Smartfolio is another one, which is available through the Bank of Montreal. I think you need to find a tool that you're comfortable using, that feels good to you. And I would also call their customer service lines and see how they are responsive to questions that you may have. And then they have a lot of resources that they provide you with online. And so I would just take a look at them, see what feels most comfortable to you, and get started. InvestorLine also is another online tool. All the banks have online brokerage accounts that you can gain access to. So I think whatever bank you're with, I would look at what options they have available, and then look at some of the robo tools that are out there. Which investments have the highest rates of return? Well, generally those would be stocks, just because like a stock can have a return of 20 or 30% in any given year. They can also have a 20% downside too. Like there's no limit to how much a stock can go up in a year, and no limit to how much a stock could go down in a year. Right now I have some money in investments. How can I tell if I'm getting a good rate of return? So I would just look at how your portfolio is set up. So do you have, 10% invested in bonds, or 20%, or is 100% of your portfolio invested in equities? And then you can look at what's called a benchmark return. So look at how much the stock market has performed in the past year or two against your portfolio, just so that you can see, how are you outperforming or underperforming your asset mix based on that benchmark. Does it work if you use a TFSA on apps like Wealthsimple, or is it better with a bank? No, it works. Either is good, as long as you're keeping track of your TFSA contributions and you have and it's invested, right? Like not staying in cash. Either works. For the TFSA, do I mean you can't contribute, withdraw, and contribute again in the same year, even if you have a contribution room left and you only contribute up to that limit? Well, if you have contribution room left, you could, but I would call the CRA before you do that and just confirm that you are allowed to do that, because the rules that they have set out are very specific. So I would call them and let them know that you're going to be using that room that you have left, just so that there's no confusion about the withdrawal, the contribution, and the withdrawal, and then the contribution again. Okay, I think, Robo Investing. So I think, honestly, I think it's a great starting place. I think if you have, a bigger nest egg, I think you would want someone to be looking at that with you to make sure that the investment decisions are being made in the right manner. But robo investing, especially when you're starting to build out your portfolio, I think it's a great tool, and I think that's why it's so popular. If I was planning on having kids in the next few years, are there any good tips to minimize the financial hit? Are there good ways to go on mat leave? So are there any good ways to go on mat leave? I think it depends on the company that you work for. Do they provide you with a maternity leave top up? Like, will they give you four extra months of income, or will you depend only on the EI? And then I would be looking to maximize the EI and also start like a small savings account for yourself to save, extra money where you can, so that you don't feel the financial hit, quote unquote, as much when you do go on maternity leave. And then in terms of minimizing the financial hit, you can buy used goods online versus brand new for some stuff if you're comfortable with that. So that's really really what I would be looking at. But I would start a small savings account on the side, just so that you have access to, you know, a slush fund, quote unquote, and you can call it your maternity leave emergency fund. And also look into the policies that the employer that you're working with right now have when it comes to maternity leave. For those of us living in the US, do American banks offer the same advising service? Yes, they do. And there's actually, in the United States, they have a lot more independent advisors. They're called RIAs. So RIAs are basically advisors that used to work with like a Morgan Stanley, a JP Morgan, Citibank, any of the big banks, that left and started their own shop, their own brokerage. So they would be the same, you know, like advice that they offer. And then in terms of the free investment advice, by going into your local bank, they should be offering that in the US as well. But again, the US is different because actually the access to investment options are much more vast. So like the Charles Schwabs of the world, I mean, like we're talking, they offer free, like free trades. So I think that there should be a lot more free options down in the States. And I would just look into that if you maybe Google it, just to see, you know, what options are available in the United States. Okay, I will stop sharing my screen. I think I stopped sharing screen. Okay. What is a good nest egg? Well, that depends. You know, nest egg threshold for a full service advisor. I think if you want to start working with a full service advisor, you want to have at least between $100,000 to $250,000 saved, so that, you know, the fees that you're charged in the account, you're happy to pay them for that advice, right? Once you start getting to a bigger portfolio like that, you have access to different types of investments, and that's why it makes sense to pay those fees. The robo advisory services that are out there have very minimal fees, and they can help you build up that nest egg to get to that $100,000 or $250,000 mark to work with a more full service advisor. Okay, I think those are the last questions. So if I take, if I have a corporation and take out personal income from the corporation as a salary, does it make sense to contribute TFSAs? If I take out more money from the corp, I will be taxed more. So this is a very specific question when it comes to the tax planning piece of having a corporation. So if you're taking money out of a corporation as a dividend or as a salary, I think it still makes sense to contribute to a tax-free savings account if you need to take out income from the corporation. But if you can keep money inside of your corporation, you could open a separate investment account that would allow you to just invest the funds and then only take out the money that you would need for living off of, and then speak to your tax advisor and see, does it make sense for me to take out an extra $6,000 a year to maximize my tax-free savings account, you know, to try and balance that out a little bit, to have personal savings as well as the corporate account savings. Okay, so all right, that was the last question. So thank you everyone for attending. We really appreciate it. Do stay connected with the McGill Women's Alumni Association via LinkedIn and Facebook. I am going to send out those books so that they can post it on their social media network. For the upcoming Savvy Women Investor Series taking place this month, click here for details. So she's put that in there. And then just a reminder that there's going to be a survey at the end. Please fill that out. It will help us provide feedback for the next one. And also, if you would like more information or if I can send you anything, you know, just let me know. That will be through the next Survey Monkey that you'd be filling out. So just let us know, and happy to connect with anyone on LinkedIn. and happy to take any calls for any questions that I didn't answer or didn't get to today. Happy to answer any questions you may have. So thanks again, and I really appreciate it. And luckily, all of my kids and dogs cooperated today, so that was great. So thanks again, everyone, and stay safe.